For the first time in recent memory, a massive divergence is tearing through the Forex markets. Look at this animation showing iron ore prices plummeting on a grid, while at the same time, the Australian dollar violently diverges and rockets upward. For 30 years, intermediate traders relied on a simple formula, an iron ore correlation of 0.85. The Australian was treated strictly as a proxy for Chinese steel production. If they were building skyscrapers, you bought the AUD. It was a physical infrastructure trade, built on open-pit mines. But if you are still looking to the Dalian Commodity Exchange to find your Australian dollar bias, you are trading in the rearview mirror. Relying on raw steel data today is actively getting traders stopped out. The macro landscape has shifted. As global investment flows move from urbanization toward electrification, the base drivers behind the Australian dollar are changing. Success in the current market requires moving past the old Pilbara iron ore playbook. To find an edge, we have to look at how the currency is now tracking the global battery supply chain. Australia has become the primary supplier for the global battery supply chain, providing the critical minerals required by gigafactories worldwide. That brings us to the green metal basket, specifically copper and lithium. Look at these stacked sheets of industrial copper cathode. This is the physical asset carrying a high beta, driving the currency's value. The catalyst for these aggressive moves starts in places like the London Metal Exchange. When the LME reports a sharp inventory drawdown for copper, it triggers aggressive institutional buying in the AUD, even if the US dollar is showing broad strength. This chart shows the exact relationship. Notice the sharp breakout in the line graph labeled copper on the left. Now, follow the timeline right. There is a distinct 12 to 24-hour lag before we see a proportional spike in the AUD-USD graph. That specific time delay is your window of opportunity. It gives modern institutional traders a structural, predictive edge over retail traders who are still trying to short the Aussie based on yesterday's iron ore data. Because the Chinese yuan is tightly restricted by the People's Bank of China, global capital needs an escape valve. Traders use the highly liquid AUD-USD pair to bet directly on Chinese industrial health. This illustrates China's credit impulse. Watch central bank liquidity become industrial orders, flowing into Australian exports and creating a rising AUD trendline. But institutions set traps first. After positive data, a sharp downward candlestick stop run triggers retail stop losses before driving the currency higher. While China drives export demand, domestic policy creates an opposing force. The Reserve Bank of Australia is dealing with persistent domestic housing inflation, forcing them into a higher-for-longer rate stance that directly contrasts with a cooling U.S. Federal Reserve. This interest rate divergence allows traders to collect the yield difference as a daily credit. This carry trade becomes a powerful incentive for holding long Australian dollar positions. You have to protect that yield advantage. Use overnight indexed swaps, derivatives that track what the market actually expects central banks to do, to monitor the real expectations versus the RBA's rhetoric. If the market prices in a hike, but the RBA holds, that dovish disappointment can wipe out your carry trade profits in a single day. When you identify a rising Chinese credit impulse and combine it with an active RBA yield advantage, you have isolated the foundation of a high-probability green Aussie trade. Executing this strategy means navigating the daily Asian trading sessions, which suffer from thin liquidity compared to the London and New York crossovers. Intermediate traders often misinterpret these low-volume price spikes as true market direction. Take a look at this candlestick chart marking the 00 GMT Sydney Open. Notice how the price sharply breaks below this horizontal support line to grab liquidity and then immediately rejects the breakdown. This is a classic maneuver where large institutions push prices through visible support purely to trigger retail stop losses. The execution tactic here is fading the Sydney Open. Watch the timeline expand to the 01 GMT Tokyo Open. This is where heavy volume bars finally appear, confirming a sustained, legitimate trend running in the exact opposite direction of that initial stop-run trap. Once you navigate the Asian session traps, your technical chart patterns require validation from the physical markets. We call this commodity price action confirmation, fusing your technical setups with macro raw material flows. This split-screen overlay shows the ultimate 2026 execution setup. On the left, the AUD USD chart is touching a 61.8% Fibonacci retracement line, a key accumulation zone. Simultaneously, on the right, the copper chart is bouncing cleanly off a major diagonal support trend line. This aligns perfectly with the overarching rule of high beta risk sentiment. If global equities like the S&P 500 are rising alongside copper, the macro environment is fully primed for buying the Aussie. The global transition toward renewable energy has altered the AUD's sensitivity to industrial metals. Relying on 20th century iron ore correlations now provides an incomplete picture of the market. Stop leaving pips on the table with outdated data. Download our 2026 commodity correlation cheat sheet from the link below and start backtesting these green metal confluences on an FXNX Pro demo account today.